If you believe markets are efficient, rational, or fair, you are looking at the wrong data. There is a financial bomb that has been armed. It is ticking, and the detonation window is opening rapidly. This is not a theory based on speculation. It is a structural certainty wrapped in a derivatives trap that the mainstream financial media refuses to touch. They are ignoring it because they either do not understand the mechanics of gamma exposure or they are terrified of the implications. We are witnessing the setup for the single largest forced buying event in the history of the silver market. It does not hinge on supply and demand. It hinges on one specific number, exactly $80. That $80 price point is not arbitrary. It is the strike price where 200,000 call option contracts are currently sitting, waiting to expire. To understand the violence of what is about to happen, you must understand the scale. Each contract controls 5,000 ounces of silver. When you do the math, 200,000 contracts multiplied by 5,000 ounces equals 1 billion ounces of notional silver exposure, all concentrated at a single strike price. To put that obscene number into perspective, the entire planet mines approximately 830 million ounces of silver in a year. We are looking at a paper derivative position that exceeds the entire global annual mine production, and it is set to detonate if the price touches $80.01 for even a single second. The mechanism that triggers this explosion is called a gamma squeeze. It is a concept rarely taught outside of institutional trading desks because it reveals the fragility of the entire system. When a market maker sells a call option, they are theoretically neutral. They do not care if the price goes up or down, provided they hedge their risk. They hedge by buying a portion of the underlying asset based on delta, which is the probability of that option finishing in the money. When the price is far away from the strike, the delta is low, and they buy very little. But as the price approaches that $80 wall, the delta does not move in a straight line. It accelerates. This acceleration is called gamma. Right now, the banks and algorithms that sold these calls are only partially hedged. They are bought perhaps 600 million ounces of paper silver to cover their risk. But if the price crosses $80, the math forces them to be fully hedged. The difference between where they are now and where they need to be is approximately 350 million ounces. They will have to buy that amount not over weeks, but potentially in minutes. This creates a feedback loop from hell. As they panic buy futures to hedge, they drive the price higher. As the price goes higher, their algorithms force them to buy even more. It is a liquidity avalanche, identical to the mechanics that triggered the Volkswagen squeeze in 2008. Only this time, the asset is a strategic industrial metal, not a car company. The danger is compounded by the fact that these market-making algorithms are fragile. They are built on historical volatility models that assume silver is a sleepy, stable market. They are not programmed for a black swan event where 1 billion ounces of exposure shifts in an hour. When these algorithms hit their risk limits, they do not pause to think. They execute stop-loss orders. They become indiscriminate buyers in a market with no sellers. This is how you get a vertical price spike. This is how you get a disconnect where the paper price on the exchange ceases to reflect reality. While the Western banks are playing these dangerous games with paper derivatives, a different game is being played in the East. Import data shows that massive quantities of physical silver are moving into sovereign stockpiles, specifically in China. We are seeing import levels triple the monthly average. This is not retail investment, this is strategic accumulation. The smart money understands that the arbitrage between the paper price and the physical metal is breaking. If the gamma squeeze triggers and the price rips through $80, $85, and $90, the physical market will lock up. We have seen this before in March 2020, but the conditions today are far more volatile. The scenario unfolding is a classic prisoner's dilemma. The first bank to panic and hedge their exposure survives. The last bank to hedge gets liquidated because they are buying into a vertical wall of price appreciation. If this gamma wall is breached, we are not looking at a simple rally. We are looking at a regime change. The disconnect between the synthetic price of silver futures and the actual cost to acquire physical metal is about to become undeniable. The $80 trigger is not the ceiling, it is the ignition switch. Once that line is crossed, the algorithms take over, and the market as we know it ceases to function on fundamentals and begins to function on pure, unadulterated panic.